All right, welcome to Coffee with Markus. This is episode 64, and today we are going to talk about the markets. We're going to talk about the three stocks of today. We're going to talk about covered calls. What is it? Who is it for? When to use it? And we're going to do a deep dive into covered calls. Does that sound good to you? Okay, then let's get started. Well, if this is your first time here, welcome. I am Markus Heidkotter, and here is why I'm doing this show. I see a lot of people starting to trade, entering the market with completely unrealistic expectations. They believe that they can take a $2,000 account into a $1 million account within a month or two. At least that's what the ads and emails are promising them. And then they start trading and they realize it's not that easy. I want to show you that trading can be simple. And I want to show you exactly what I personally do. I promise to give you tips, tricks, and strategies that I personally use in my own trading. And I'm keeping it real. I'll show you the good, the bad, and the ugly. I'll show you my winning trades. I'll show you my losing trades. I'll show you my account statement so that you know exactly what I'm doing here. Now, if this sounds good to you, then just click on like real quick or type yes in the comments and we will get started right away. Because yes, we do have a fun show today on Friday, July 10th. Because recently we talked about the poor man's covered call and I received a lot of questions around this. So I received actually a lot of questions around covered calls because in the previous video, I just quickly went through covered calls since I wanted to talk about the poor man's covered calls. So today we're going to do a deep dive into covered calls. Again, we're going to talk about what is it, who is it for, when to use it, how to use it. I'll show you specific examples. And also I answer the question, can you do this in retirement accounts? But first, let's get started and let's talk about the market. So it is Friday. The S&P right now is on session high. So if you switch to a 5-minute chart, you see here's what happened today. So today we opened around the unchanged mark and have been drifting higher ever since. So why are we higher today? Well, there's no real news. We're just drifting higher going into the weekend. Yes, there were some news regarding some possible vaccines from Gilead, who has the drug remdesivir, whatever it is called, and from a German company who said, you know what, we might have a vaccine by the end of the year. So these are the news for today. But if you zoom in and see what happened here this week. So this is where we opened on Monday, right here. This is where we are today. So as you can see, the whole week we didn't even move 1%. As you can see, the markets were diddling around, whether we're looking here at the S&P or the Dow. Why? Because there's nothing really moving the markets. Now, next week, this might change because next week, earnings season is kicking off and we will hear from companies. How did the coronavirus, how did the pandemic affect them in the last quarter? So I expect more movements next week. Now, the NASDAQ today a little bit lagging, but as you can see, the NASDAQ was pushing higher and higher because tech stocks are doing good. Let's talk about a few stocks that are moving the markets right now. So one of them is Tesla. And here is why I believe Tesla is going up today. In a few days, let me just show you. So on July 22nd, Tesla will report earnings. And it might be that they're reporting another profitable quarter. Now, you might wonder, why is this such a big deal? Well, Tesla hasn't had a winning year yet. It hasn't had a profitable year. So, and this could be the quarter where Tesla would have had 4 consecutive quarters with a profit. Now, again, you might wonder, so why would I care? Okay, they had 3 consecutive quarters. That is a difficult word. Can you say consecutive quarters 3 times fast? Anyhow, they had 3 of these consecutive quarters with a profit in a row. And if this quarter, the last quarter, is profitable too, they are eligible to get into the S&P 500. Now, why is this a big deal? Well, once Tesla gets into the S&P 500, more institutional investors can trade Tesla. Because some of the hedge funds in their prospectus, they have written, okay, we can only trade stocks, or we are only trading stocks of the S&P 500. And so this means that thus far, they couldn't trade Tesla yet. And they haven't been missing, or they have been missing out on this explosive move that Tesla made. So again, July 22nd will be an important date for Tesla. And today, some investors are speculating that it could happen. This is why Tesla is up 10% of the day. A few other stocks that are right now moving, unfortunately, uh, American Airlines. So if you look at, I don't want to just use one of the airlines. I'm going to go through all of the airlines. They're up today. Why are they up? Well, because right now there's rumors that there might be a possible vaccine sometime soon. And with the United States having more and more record cases, I mean, take a look at this worldometer. Um, Look at this. These are the daily new cases here. Isn't that crazy? I mean, we are at highs. Let me just zoom in a little bit if I can. There we go. We are making new all-time highs in terms of cases. So this is not good, but we have been doing this for a while. So this is why the markets currently are shrugging it off. But again, all the airlines got hammered because of that. And right now there's a little bit of hope. So American Airlines up 6%, United Airlines up 7, almost 8% here. Delta Airlines also up today. And one of the stocks that really surprised me today, Carnival Cruise Lines. Carnival Cruise Lines up 10% for the day. Why is this? Well, because they said that there's a strong demand for cruises when they are resuming sometime soon. In Germany, they're resuming cruises in August already, but they say we see a lot of bookings for 2021. Seems that some people are just cruise junkies and can't wait to get back on a cruise ship. Well, I don't know about you. For me, it's not for me. So I have done cruises twice thus far. And that does it for me. Anyhow, so this is where we just wanted to talk very quickly about what's happening in the markets. And in a moment, we're going to talk about covered calls because there was a lot of interest and I want to make sure that I'm covering it. So good to see everybody here. Dion, so good to see you. Ihor says, happy Friday. Guglielmo, good to see everybody here. And Angela says, yeah, people are traveling and getting good deals on Expedia. My son and friends got a great deal of going to Antigua. Yeah, I mean, of course, right now, I mean, whether it is airlines or cruise lines, they're giving you great deals because they're shut down and they want you to book flights. They want you to book hotel rooms. They want you to book cruises. So that's definitely happening. All right, let me just switch over here to a different chart because we just want to go through the markets here in the beginning very quickly, but then I want to give you strategies that you can use in your trading right away. Now, if you just take a look at the agenda really quick, so if you have just been tuning in, this is episode 64 of Coffee with Markus. We just briefly talked about what's happening in the market. We talked about top 3 stocks of the day. Right now, I want to talk about covered calls, and then we're doing a deep dive into covered calls where I'll answer all of your questions that you might have around covered calls. All right. So let's get started. Let's talk about covered calls. And I want to share my desktop here because what I want to cover, and let's call them covered calls, is that I explain to you exactly what is it, should you trade it? I will give you a very specific example, and we'll talk about can you do it in a retirement account. Now, covered calls are fascinating, and covered calls are usually the first option strategy that new traders start trading because it is super simple to understand, and it is perfect for you if you already have stocks in your account. So let's talk about it. What is it? It complements the current stocks that you have in your account. And we're talking about long-term stocks. We're not talking about trading. We're talking about stocks that you might hold for a longer time, like months or maybe even years. So let me give you an example. And the example that I want to give you here is for JP Morgan. So JP Morgan, as you can see, during the pandemic, got hammered when it came all the way down from $140 to only $80. And right now is just trading shy of $100. Now, you might have JP Morgan in your portfolio. You might have had it in the portfolio before the pandemic. So let's just go to a monthly chart. Because if you look at a monthly chart here of JP Morgan, you see that overall, it is a good company. Or maybe even you work for JP Morgan and got shares. It doesn't really matter. It applies to any stock, whether it is IBM, Boeing. So if you do have stocks in your portfolio, let me show you what to do. Because right now, if you had JPM before the pandemic hit, you're underwater. I mean, right now on this one, you're losing money. Now, again, full transparency, I don't own JP Morgan. I don't any stocks long term. I trade between 5 and 25 days. That is my typical holding period. And if you want to learn more about this, there's probably a link in the description where you can learn about my specific trading style. But this is where we are at. So let's say that you got it at 120 and 130. Right now it is trading at 96. You still have this stock in the portfolio and you hope that eventually it'll go back up. You're not willing to sell it just yet. So let me show you exactly what you can do with this. So first of all, if we had JPM, the stock, okay, and let's just say, for the sake of simplicity, that you would buy it today, that you would buy it at, let's say, $96 right here. $96. So buy 100 shares for $96. Now, the capital requirement for this, if you would buy it right now, would be 100 times $96 per share. So we're talking about $9,600, close to $10,000. Now, when you have a stock, it is very easy to understand how stock moves. If the stock moves up by $10 to, let's say, 106, you make 100 shares that you have times $10. So this means that you're making $1,000. Now, if the stock goes up by $20, let's say the stock goes up to 116, you would make $100 times $20 because you bought it for $96, right? And you're selling it, or the stock is right now at 116. So you would make $2,000. And if the stock goes down, let's say the stock goes down from 96 to 86, super easy to understand, right? It is 100 times 10. So times $10. So you would lose $1,000. So many people are trading stocks and they're very familiar with this. So let me color this and then let's talk about a covered call and why it makes sense, or why it might make sense for you to trade a covered call. But I'm going to just make this a little bit more colorful because colors make me smile. Yes, you can quote me on this. Okay, so how does it work? How does it work? And this is still under number one. You're selling one call for each 100 shares that you have in your portfolio. And here's what you do. When you sell the call, you choose a short-term expiration. And here in this particular example, we will use a 7-day expiration. So we will choose a call that expires in 7 days from now. And we are choosing, there we go, choose a so-called out of the money call at a strike higher than the current price. Okay. This making sense thus far? So let me show you what strike might make sense. And then we're going to pretend to put the trade on. So if you look at JP Morgan right now and you say, okay, I want to see, I will sell a call that expires on, what is today? Let's say July 17th. So right here, in a few days, in 7 days from now, that's 5 trading days. So what do you think? How high could JP Morgan go over the next few days? Let's just say that you think it will not go higher than 107.50. So we can choose this. And we'll take an option chain right now, and we'll see if this strike price actually makes sense. But if you look at JP Morgan, you see this would be quite a significant move for JP Morgan. It means that it would have to go up almost 10%, now a little bit over 10%. Is this likely over the next few days? Probably not very likely. So let's actually go to a trading platform. We're going to log in right now, and I'll show you exactly what this trade would look like and why it might make sense for you to put on this trade, because there are some very specific examples. And of course, just as I want to do this, my trading platform decides to do a quick update. No problem. It's doing it right now, and it will be up and running here in just a second so that you see exactly one of the brokerage accounts that I personally use. And this is on Tastyworks because Tastyworks makes it really easy to see what happens when you put on a covered call like this. Okay, so there we go. There we have JP Morgan. Okay. And at first I want to say, okay, what happens if we put on a trade and if right now we put on 100 stocks? So here, if we look at the curve, again, very, very easy. As long as JP Morgan goes up, we are making money. If JP Morgan is going down, we are losing money. Okay, so super easy to understand. Now we add to this a covered call or a call. So we're selling a call right here with an expiration of July 17th. So as you can see, this is in 7 days from now. So a short-term expiration here. And we'll pick a strike price where we say it is not very likely that over the next 7 days, which is 5 trading days, JP Morgan will go above it. And I believe this is where we said, what did we decide on? 107.50. Let's do 107 right here. So this is where we would sell a call. And as you can see right now, we would receive 55 cents for it. So this means if here we buy the 100 shares for $96, or let's say we still own them, right? And at the same time, we would sell the 107 call that expires 7/17, so in 7 days for now. The capital requirements for this are exactly the same. So the broker will not ask you for additional capital requirements when you're selling a call against stocks that you're owning. So here it is still $9,600. Now, here's the deal. You are receiving right now $55 if you are selling this call because options are being traded in 100 packs. By the way, if you're unfamiliar with options and you would like to have an options 101 course, I got you covered. In fact, it is for free. If you go to rockwelltrading.com/101, I'll send you an options 101 course. There's 12 lessons completely free. Just enter your email and your first name so that I can address you by name. And this way, you would get this course that explains you more of what all options are about. So if the stock goes up to, did I pick the right strike price? Yes, here, okay. So if the stock goes up to $100, you would make the $1,000 that you make on the stock, there we go, plus you make an additional $55 that you receive as a premium by selling one of the calls. Now you might say, $55? That doesn't make sense. Well, bear with me for a second because you'll see why this might make sense for you. So as you can see, you're increasing your profits by $55. Again, not a whole lot, admit it, but wait for it. It'll get really, really good. So the same is true if the stock goes up to 116. So in this case, you would make $2,000 plus $55. So you would make $2,055. Now, lastly, of course, if the stock is going down, you lose $1,000, but you're keeping the premium, the $55. So therefore, your loss gets reduced to $945. So it is still a loss, but as you can see, the loss is smaller than here. Now, again, the question is, why would you worry about $55? Well, let's continue our math. So what you're doing here is you make $55 in 7 days. So this means if we take the $55 divided by 7 days, that you make approximately $8 per day. Now, $8 per day, let me actually write it down this way, per day. So based on the initial capital, so if you take the 8 and divide it by $9,600 that you had to invest in order to buy the stocks, it is not a whole lot. So I'm bringing up my handy dandy calculator here, but as you will see, so it is $8 divided by $9,600 times 100. So you're making approximately 0.8% per day. 0.08% per day. Now you might say, what the heck? That's nothing. But if you take this 0.08 and multiply it, where do I have my calculator? Where did my calculator go? Disappeared. Okay, there it is again. And take this times 360, you would make an additional 30% on this stock. Now you might be wondering, why do I do it per year? So 0.08% is 30% per year. Now this is in addition whatever you make on this stock, it is going up. So what do you think? Does this sound a little bit more exciting if you make an additional 30% per year? The $55, that's not the deal. The $8 a day, it's not a big deal. And there are possibilities where you can make more money, where you can make $10 a day, $12, $15. Sometimes with the right stocks, you can even make $20 a day or more. So this then means that you're making not only 30% additional per year, but you would make what, 40, 50, maybe even 60%. So this is why I believe if you own stocks that you want to hold for the long run, that is why important. So should you trade it? Absolutely, if you're holding stocks in the long run, because it is almost like free money. Now, one of the things very important that you need to understand when selecting the strike price, and you see we selected here a strike price of 107. If at expiration, if the stock is higher than the strike price that you selected, you have to sell the stock at this price. So if, for example, in the next 7 days, the stock goes up to 107, what did we say, 107? Yeah, okay. So this is where we need to address this here, okay, very important, because if it goes up to 107, you have to sell your shares for $107. So you would only make $1,100, right? Because it goes from $96 to, you have to sell it at 107. There we go. It goes up to 107. You would have to sell it. So you only make $1,100 plus $55. So this is the one danger of trading a covered call, because you might lose the shares. But here's the deal. What can you do the next day? The next day, you can buy the shares again, especially these days where stocks are super inexpensive. So I wouldn't be too concerned about getting called away, because you can buy them back the next day. Anyhow, if you like this idea of covered calls, and in a moment here, we're doing a deep dive and I'll answer your question. But if you like the ideas of covered calls, I decided to do a class on covered calls to show you exactly of how to do this. Not quite sure yet, although to be honest, if I will do it, but you can register at rockwelltrading.com/blueprint. This is only a wait list. You can register on this wait list, and if I see that there's enough interest, I'll do the class. Now the class will be super inexpensive. It's very affordable. So trust me, the class will not cost $1,000. It will not cost $500. It'll probably not even cost $200. Haven't decided yet. So just let me know if you're interested. If so, put your name on the list here. And then if there's enough interest, I will announce the date and also the investment for this class here. And I'll explain in detail what covered calls are, what strike price you should select for which stocks they make sense. And we also talk about the poor man covered call that we covered in the previous video. So just to wrap it up here, first of all, what is it? What is a covered call? Well, it complements the current stocks that you have in your account. You would sell one call for each 100 shares that you have in your portfolio. You choose a short-term expiration of 7 to 14 days. Choose an out-of-the-money call at a strike higher than the current strike price. Should you trade it? Absolutely. Here's a specific example. And now the key question is, can you do it in a retirement account And the answer is yes, if you can trade options. And in order to trade options, you have to tell your broker that you want to trade options. So yes, it is possible to do it in the retirement account. Talk to your broker. Talk to your broker, because your broker might ask you, okay, what exactly do you want to do? And he has to give you special permission. Anyhow, hope that this video helps. And if you found this helpful, do me a favor and click on like, and maybe you want to subscribe to this channel. Click on subscribe, hit the little notification bell. This way you get notified whenever I release a new video. And there's probably a few videos right now, hopefully popping up on the screen. So click on any that sound interesting to you, and I'll see you in the next video. All right. So there are quite a few questions that, and this is why I said, what are we going to do here? So after, in this episode, we already talked about the markets. We already talked about the top 3 stocks. Now you have a basic idea what covered calls are. And right now we are doing a deep dive. So over the next 10 or 15 minutes, I'll go into more specific questions regarding these covered calls so that you know exactly what to look for. Okay, good. So I'm just going back to the questions to make to see if there are any specific questions that I want to answer for you right away. So if you have a question, and if you're watching this live here, that is the important thing. Drop it in the chat right now. If you're watching the recording, post the question in the comments and I'll get back to you and let you know what the answer is. Okay, Edward said, I believe you said that the notes can be retrieved in the member section. Isn't this only for mastermind members? No, it is not. Everybody can get these notes. It's not only for mastermind members, but if you are interested in the mastermind, if you would like to know what this is, because this is where we work together personally. If you have any interest in this, call or text Lisa at lisa@rockwelltrading.com. You can also text her at 512-858-8523, and she'll give you information. But the notes that I'm taking here are all available on our website. So I believe you need to go to rockwelltrading.com/coffee, and this is where you'll see all the notes. Great questions here. Okay, so Wayne says, interesting concept. Really love and prefer the swing strategy, but I entered a very large position in BAC about a month ago, and it went down pretty dramatically. So, Wayne, this is exactly what this is for. So if you got stuck in a position, and Wayne clarifies here and says, okay, I forgot to put the stop loss in, leaving me with 2 options: take a large loss or talk myself into BAC, Bank of America, into a long-term hold. What I really need is some type of rescue plan, I guess. So here's the deal, Wayne. Let's actually take a look at this. And again, just knowing that I don't provide individual advice, so I'm just showing this here as an example, and you're an adult. You do whatever you need to do. So you said that you got into a larger position. I don't know, maybe at 28, maybe at 26. Doesn't really matter. Maybe you got in at 30. Now, looking at Bank of America, let's zoom out, right? I mean, monthly chart. This is where you might say, you know what, in the long run, I believe in Bank of America, because here, if you see, ever since the financial crisis where Bank of America got bailed out because they went almost bankrupt, they seem to have recovered quite nicely. So they went down to as low as $20, but right now they're coming back. So here, what you could do, Wayne, absolutely, you could use this strategy and sell some calls against it, and you will not be able to probably fully recover the loss. But if you choose as a strategy to stick with Bank of America and hope that it gets back to your entry price, while it is doing it, you could sell covered calls. The important thing is make sure that these covered calls are far enough out of the money here. So I would probably choose a strike price. Let me actually see if there's any premium in there. If you go to Bank of America. So Bank of America, also the July 17th. I would probably, yeah, you're not getting much premium. So you're getting between $15 and $20. So it's not a whole lot because it is a cheaper stock. Bank of America is only $24. But hey, This way, possibly, you can work your way up. The important thing is only sell one call for each 100 shares. Don't know, Wayne, how many shares you have. If you have 1,000 shares, you could sell 10 calls, and then instead of making $15, you would make $150. Making sense? Or here in this example that we had, instead of making $55, you would make $550. Anyhow, great question. Hope that helps, Wayne. So this is something that you could do when you're stuck in a position and you don't want to cut your losses just yet. And again, I always like to have a stop loss in the market, as you know, Wayne. I mean, you have been following me here for a while. We know each other, right? I mean, you're one of the regulars here. But yeah, as you said, it can happen to that you forgot to put a stop loss in, or that you just say, I want to hold this position for the next year, 2 years, 3 years. Okay. So good to see you here. So let's talk about it. Asia says, isn't it if the stock goes above 107, you make any more profit while you sold? Yes, you're right. I corrected this. Thanks for pointing it out. So very important. Earlier I said if it goes up to 116, that you make more money, but then I corrected it. I caught myself here. Sorry about this. So yes, you are limited in the profits with the stock up to the strike price. So this is why you want to take a look at the chart and see what is realistic, how high could it go over the next 7 days or 14 days if you choose a 14-day to expiration. So again, I'll be happy to, let me go back here. I'll be happy to reveal my blueprint for this, how I would trade covered calls if there's enough interest. So if you're interested in learning more about this, in me showing you exactly what strike price makes sense, when does it make sense to use it, when doesn't it make sense, with many examples, and also talk about the poor man covered calls, get on the wait list and just say, you know what, yes, I am interested. So when you are offering the class, I might attend the class here. Again, there's no obligation. Just go to rockwelltrading.com/blueprint. Put your name on the list. This way I know how much interest there is, because if there's not much interest, I won't do the class. And if there is a lot of interest, I'll do it and I'll show you all the ins and outs here. Anyhow, good. Benito says, I got burned with a Microsoft covered call, sold a call on a slow June day, not a lot of premium that day. A few days later, there was a lot of excitement about Microsoft and premium almost tripled. So here's the deal. There is absolutely, Benito, you pointed out, there is an art to this of when you should sell a covered call, right? And this is what we'll cover in the class, just to give you a quick idea. Whenever you see that the stock is going up, there will be more premium in the call. So here, in order to establish a position, it makes sense to wait until the stock is popping up. So here, let's take a look at Microsoft. So Microsoft, you talked about June, probably here where it was slow day, maybe the beginning of June, not quite sure what you're referring to, right? And then it had this quick pop up. This is typically a day where you want to sell a covered call, right? And we'll talk about it more in the class if you're interested in this. Yeah, because this is what you're saying, Benito, is one of the mistakes that some people make, because they think when the stock is going down, I should sell a covered call. But this is when exactly what you said is happening, that you're leaving some money on the table because premiums are tripling a few days later. So wait until you see a nice pop up. Okay. Just taking a quick sip of coffee, and always make sure that you trade what you see, not what you think. Okay. So Anna and Ron said, I've done this a few times. Sell one day, buy it back the next. Make money on both trades. Good for you. This is absolute a strategy that works. It is a strategy that has a very high winning percentage. Why? Because you're going for super small profits. So I do not recommend this as a regular strategy. As you know, the way how I trade, I use the PowerX optimizer because my goal is to make at least 60 to 80% per year. So I am a more active trader. But I know that some of you are just getting started, and I believe that this is a really good strategy to get started if you're absolutely new to trading, or especially if you have stocks that are somewhere stuck in a retirement account and they're up right now upside down. Okay, so Doug says you can, of course, buy back the call if you really like the stock. Yeah, you could do this, but you see, it's easier if you just get the stocks called away and then go right back in. It's really not a big deal, and you might miss $2 or $3 in profits here on the stock, but you can do this. Oh, and I see, Deshaun says, I sold one contract except my stock expiring today. Hopefully, it expires out of the money and you can keep the money. If so, that would be fantastic, right? That is the idea. That is the idea, that you can, that it expires, that the stock stays below the strike price that you have selected. So therefore, it is super important to select the right strike price. Okay, good. So moneymakers say, can I sell stocks anytime you want? Yes, you can, unless they have been issued by your company and there's a holding period on this. You see, I used to work for IBM. And when I used to work for IBM, I got issued stocks and there was a holding period. I could not sell it for, I believe it was a year or 2 years. But if you just buy stocks in the market, you can sell it at any time. So Don is asking an excellent question. Is this a process that you would perform on a weekly basis, either every week or every other week? So this is what I'll go into more depth into this in the class of when it makes sense to only go a week out, when it makes sense to go 2 weeks out, or you could even do it monthly. And I'll show you exactly how to figure out whether it is better to do it every week or whether you do it every month. Some of the stocks don't even have weekly options. But you see, I know that this strategy is also called weekly paychecks, right? Because the idea is that weekly you are getting the premium and then hopefully you can keep the premium here. So Don, excellent question. You can do it weekly, bi-weekly, or monthly. So there's all three different ways. And yes, I would definitely do this. Okay. Yeah. Anan Ron says trading stocks is the best business I've ever been in. I'm loving it. I mean, in fact, if you go to this channel, you'll see that the first video, the welcome video, is why trading is the best business in the world. So good. Okay. So Jeff saying, do you use some formula to calculate if you should take the covered call? Many times on shares I owned, I only get 12-ish premium. So, I mean, great question. Here is what I personally would shoot for. And again, every investor is different. But if I cannot, on an analyzed basis, I want to make sure that I can get an additional 30%, right? Why only 30%? Because it's a super safe strategy. If you try with this strategy, if you try to make 50, 60%, you'll probably get burned. So it's a super conservative strategy. And this is where I'm calculating it in the way I've shown it to you. And I want to make sure that I can make at least 30%. Otherwise, I wouldn't do it. Because then, as I said, if you only get 12-ish premium, either you're selecting the strike price too far out, right? Or you're too conservative here. Or maybe it's a stock that really doesn't have any premium in there, which could be. This is why for certain stocks it makes sense, for other stocks it might not. And again, you need to have at least 100 shares for each stock here. Okay, so Asia says, if the stock goes to 86, you'll make money on the sold call, so it won't be only $55. No, that is incorrect. Sorry for correcting you. So you can only get the premium. You keep the premium, no more. You cannot make more money on the sold call. It is limited to the premium that you received. So that is not the case. Okay. So Raja is asking an excellent question. Can we use leaps in this strategy? Now, this is where, if you have been watching Coffee with Markus in episode 63, the previous episode, I did talk about the poor man's covered call. Now, for the poor man's covered call, for the buy side of the call, yes, this is where you can use a leap. For selling, I would not sell a leap, because what you're looking for is time decay, theta, and you want it to erase as quickly as possible. I did a video on this. I'll post a link in the description. It is called Theta in Options, or Time Decay in Options. It explains it in detail. And this is why when you're selling options, you want to have a really short fuse. So 7 to 14 days, maybe up to 30 days. And again, this is where if you want, I'll be happy to explain this in the class of when it makes sense to sell the weekly options, maybe one with 14 days out or with 30 days out. Haven't decided yet whether I'm doing the class, and haven't decided on a date yet. Depends whether you're interested or not. If you are, put your name on the list, rockwelltrading.com/blueprint. Okay, so Krishna is asking a great question. Is there minimum shares that we need to own for covered calls? Yes, at least 100. Because a covered call, each option is always for buying or selling 100 shares. If you would like more information on Options 101, I have a free course for you. Just go to Options 101 and you can download the course. It's actually for your phone. We have an app and it will be on your phone, or you can, of course, also watch it on YouTube. You'll see it as well. We have a playlist. It's called Options 101. Good. So Doug says, Markus, this strategy works best when markets have a trend, correct? No, not necessarily. It works best when the markets are actually going sideways. Because you see, when there's a strong uptrend, you just want to own the stock. So what you do with a covered call, you basically, I want to go back to Microsoft here because Benito mentioned it earlier. So when the market is just going sideways, like right here, this is when it is perfect. You do not want the stock to make a sudden move, because if so, you're missing out on some profits, because you're capped by the strike price that you sell. So it is best in a market that is drifting upwards. See, as we have right now with the overall market, most stocks are right now just drifting up. So this is where, Doug, this strategy is perfect for the markets right now. And Vote says it, 100 shares for one option. Moneymaker is asking, is there any fee to sell stocks? Depends on your broker. Depends on where you live. In the United States, these days, it is pretty much free to sell stocks. You pay a small regulatory fee. It's almost like your cell phone bill. Have you ever looked at your phone bill where AT&T or Verizon are charging you something, and then you have a few cents regulatory fees for the FCC or whatever it is, right? So same here, you still have to pay a very small fee, but these days it is pretty inexpensive. Okay, good. So Stan says, if you have 200 shares of Starbucks, where would you put the covered call? We can take a look at this. So Starbucks, let's take a look at this. So SBUX, first of all, we want to make sure, this is perfect. You see this, we're going back to Doug and also here for Stan. This is a perfect stock for this strategy because, as you can see, Starbucks right now is not going anywhere. So again, I'm assuming, let me just look it up here. SBUX, Starbucks, has weekly options. And let's see, we could probably go for the 78. Let's go back to the chart here. Yeah, so again, we're looking for Starbucks over the next few days until July 17th. And now this is where you need to look at it and say, what is realistic? I mean, honestly, I would feel more comfortable with an 80 strike price. But the problem is, in an 80 strike price, you don't have any premium. There's only 10 cents. This translates into times $110. So it's not a whole lot. So Starbucks is one of the shares where right now you're not getting a whole lot. So you would have to be a little bit more aggressive. Let me go back to the charts. Or this is what I want to show you exactly in this class that I'm planning to do. Does it make sense to really sell covered calls on Starbucks? It might not make sense because you're not getting the 30% per year that I would be looking for. So in this case, I would say, well, okay, what other stocks do you have? Is this helpful? Okay. Good. And Dushan says from earlier, yeah, it's expired, out of the money. Okay. So Caleb is asking a great question. Do you still sell covered calls while also trading the PowerX strategy? I personally only trade the PowerX strategy. I do not have any long-term stocks in my portfolio. I used to do it way back in the days when I was still working for IBM. Obviously, I had thousands and thousands of shares of IBM because I was a director at IBM, and part of my compensation was that I got options, and then these options converted into shares, and I had quite a lot of shares from IBM that were also locked in, so I couldn't sell them necessarily. So Caleb, these days I am trading the PowerX strategy. That is my bread and butter strategy. But I wanted to share this with you because, I mean, we saw it earlier. You might be in a stock, or you might have had a stock from years back that is a perfect candidate for this strategy of having covered calls. Again, not every stock is perfect. Starbucks looks like it might not be a perfect candidate. I would have to calculate it. Don't have too much time for that to go through this right now. Okay, good. All right. Vote says the PowerX strategy is super. I'm loving it. Yes. So Roger says, can you sell the stocks and keep the covered call? Wouldn't it be trading naked then? Yes, and this is where it really depends. It is super risky when you do this, because now if the stocks plummet, if the stock skyrockets, right, it can get very expensive. I wouldn't do it. And especially if you're trading it in a retirement account, most brokers will not allow you to sell the stocks while you still have this covered call, because you're absolutely right. Yes, you said it. Then it's no longer a covered call, then it is a naked call. So if you are doing this strategy, I highly recommend keep the stocks until the call expires, which is, again, only in a week or 2 weeks from now. And afterwards, you can sell the stocks. Okay. Don says, thanks. You're very welcome. Okay. Good. Yeah, as I said, don't get greedy to buy back the stock. Yeah, I mean, this is a strategy where you can't get greedy. You have to be super conservative, 30% per year. And again, this is where you might only get $55. So it's not a whole lot. So we talked about $8 a day, not really a whole lot, but always keep in mind, this is in addition to what you're currently making or losing. So if you have the stock and you're making money or losing money on the stock, these $8 per day are in addition. And $8 might buy you a coffee. All right. Wonderful. So, geez, time is flying when you're having fun. Let's take 2 more questions here, and then we're going to wrap it up for the weekend here. So Nofoma says, can you please explain buy right covered call? Not quite sure what you mean by this. If you're meaning the poor man's covered call, I did this in the previous video. We'll post a link here in the chat or in the description so that you can watch this. Not quite sure if you're referring to this. So Ricardo is asking, if you have 1,000 shares of a company, you would want to sell 1 covered call. Do you have to buy 100 shares? No, if you have. So if you have, let me go back. It's a great question. And with this one, we are wrapping it up. You sell 1 call for each 100 shares. So if you own 1,000 shares, you can sell 10 calls, up to 10 calls. You don't have to sell 10, but you could. And in this case, for this specific example here, instead of only making $55, you would make $550. So instead of $8 per day, you would make $80 per day. And this is more fun. Isn't it more fun to make $80 per day than $8 per day? So great question here. And yes, absolutely. If you have, for every 100 shares, you can sell 1 call. Okay, 2 more questions because we're having so much fun. Charles asking, the demo account on Nadex, good for only 30 days. If you go to rockwelltrading.com/Nadex, you can sign up for a demo account that does not expire. So rockwelltrading.com/Nadex. If you go through this link, you will get redirected to a demo account that does not expire. And Per is asking, is your book PowerX Strategy going into details of how you trade the strategy? Does it cover different strategies in different markets? This book that you're referring to, the PowerX Strategy that you see in the background, describes one of the strategy, which is my bread and butter strategy. This is a strategy that I'm trading every day. I'm using this strategy to trade stocks and options. And in this book, the strategy is described in detail, and also how I trade options. I'll be happy to send you a book for free. So you can either go to Amazon and buy it from Amazon for $25, or you can go to my website. I'll send it for free as long as you pay for the shipping, which is $4.95. So shipping and handling is $4.95. I'll be happy to send you this book. I'll be happy to send it internationally. As you can imagine, I will lose money on this, but I think that this is a great book. And once you have it, I'm pretty sure that you might want to invest in the PowerX Optimizer, which is the software that makes it so much easier to apply everything that you learned in the book. You don't need the software, but many people who bought the book eventually invested in the software. Anyhow, if you would like to have this, there's a link in the description. Feel free to check it out. No strings attached. It's $4.95, and I'll be happy to ship you a book to wherever you are. Okay. Listen, this has been fun. If you are interested in learning more about covered calls, and if you want me to do a class and show you exactly how to do this, how to select the strike price, how to select the expiration, whether we go for weekly expiration, monthly expiration, whether it makes sense for a particular stock to do it or not, just say, I'm interested. Go to rockwelltrading.com/blueprint, put your name on the list. And if I see that quite a few people are interested in this, then I'll do the class and I will send you an email of when it is and how much the investment in the class would be. And again, it will be super affordable because I promise my idea is that you make back the investment in this class with just one, maybe two trades. Okay, so anyhow, I wish you a great weekend. Stay safe, stay healthy, and we'll see you in the next Coffee with Markus. These shows are Mondays, Wednesdays, and Fridays at 3:30 Eastern Time, 30 minutes before the markets close. So I hope to see you in the next show. Take care, everybody.